we've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular, agricultural products perhaps, because I think these prices are going to rise. They're going to rise very, very substantially. That's going to be the new place to go. And good technical analysts are already seeing this beginning to develop in the wider commodity sphere.
The chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore.
The global economy is witnessing a decisive shift as investors increasingly abandon paper assets in favor of tangible stores of value. Andy Schectman cautions that the next major wave of capital will likely move toward mining, base metals, and agriculture, as their intrinsic worth becomes more apparent amid rising costs and dwindling trust in fiat systems. The debt-driven structure of modern finance is beginning to fracture, revealing the fragility of currencies detached from real productivity. Alasdair Macleod observes that institutional money managers and chief investment officers are now endorsing gold, a transformation few anticipated. His projections proved accurate, as gold surged nearly 46%, rising from around $2,652 per ounce in late 2024 to nearly $3,995 a year later. This reflects waning confidence in central banks' ability to stabilize markets. Both Schectman and Macleod envision a world where physical assets, gold, silver, and core commodities anchor the next phase of financial stability, redefining wealth through tangible value rather than paper promises. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I mean, it is interesting that the first time, certainly during this fiat currency life, which is now, 54 years and counting, we actually have major investment managers, or rather, I suppose, investment strategists turning around and saying you ought to actually allocate 5, 10, 15, 20% of your portfolios to gold. The thing that's interesting is that these big banks, they've got massive amounts of funds under management. And, we're talking about the sort of net worth individual portfolios. The sort of thing I understand people like Goldman's have got about $1.25 trillion under management, Bank of America another trillion, trillion here, trillion there, and all the rest of it. And they got nothing. They've literally got no gold in there at all. They don't know how they're going to get it. I mean, really, and there's another problem, and that is that how do you invest in gold? Well, your compliance officer won't give you hell if you buy an ETF, but an ETF is actually quite an expensive way to do it. What you should do is buy physical metal and store it properly, and it'll cost you, basis points, no more than that. But the problem there is that gold and silver are not regulated investments. So you've got a lot of explaining to do to your compliance officer. But that's the best thing to do. I'd sort of calculate, if you look at the actual level of exposure at the moment, portfolio exposure to gold around the world, and we're talking about an estimated 300 trillion of portfolios total around the world, their exposure is about 0.5%. If you're going to increase it by only 1%, at current prices, that's 25,000 tons. Where are you going to come from? It's just not there. That basically is the gold leasing game. And a lot of this gold has actually gone. It's disappeared. I mean, the leasing game has been going for so long. Analysts back in the last century were looking at it and saying, where's it gone? And they were assuming that after a lot of diligent research, I should add, that up to a third to a half of all central bank gold by 2002 was out on lease. And the way Frank Venerosa put it was probably adorning the necks of women. I actually think China bought it, but who cares who bought it? It's not there. I mean, that's the key thing. So we actually do have this additional problem. I mean, the idea that you're going to have time to, sort of cogitate and wait to see developments and all the rest of it. I mean, you could end up missing the boat hugely on the gold game. And of course, the thing about silver is that it's always been the poor man's monetary metal, as it were. And, if they think they've missed the gold boat, they'll go and buy silver. So, and there's not a lot of liquidity there. I mean, I'm seeing that in China, stocks have dropped to well under 1,000 tons in the SHFE. This squeeze is evident again. And I see that this morning, there's a small backwardation between spot in London and COMEX. So that's returned.
First of all, to your first question, guys like Jeffrey Gundlach and Michael Hartnett and the CIO, Chief Investment Officer of Morgan Stanley, are not speaking to the plebes. They're speaking to institutional level traders. So they're telling the people at the top of the financial food chain, this is something you've never heard from us. So we're couching it by just calling it 60-20-20 or 25-25. Michael Hartnett's newsletter is so expensive that no one mainstream reads it unless you are a institutional sized trader or hedge fund, running a hedge fund or whatever. These people at the top level are being given the acknowledgement, the wink of the eye, if you will, by the same banks that have been suppressing the price. At the same time, we've talked at length about, and I started my first couple podcasts with you in 2020, we talked about the others that showed up on the Commitment of Traders report, which there was always just two groups of reportables. The largest positioning in the Commitment of Traders report published by the COMEX were the hedge funds and the commercial banks. Then all of a sudden there's this group called the others. Who are they? They are sovereign wealth funds. They're central bankers wearing a different hat. They're friends. They're an offshoot, if you will, or family offices of tremendous wealth started standing for delivery, which I'm like saying to you, Dunnigan, this never happens. What, less than 1% have stood for delivery my whole career? At this point, it's been 30 years I've been doing it. Something's not right. And now we see it. Of course, we've seen it with almost 40 central banks repatriating their gold from the Bank of England and the New York Federal Reserve. Early adoption into backwardation right now. We see problems of getting the metal. Sorry, there's a 8-week delivery delay, folks. We have a shortage of manpower and trucks in London, we were told. Or, not really a good example, but gets the point across. Venezuela says to Bank of England, can we please have our gold back? No, you can't. And when you see 40 countries pull their gold home from the Bank of England and New York Fed, they were there because for many years you had the Western rule of law and stable, liquid, efficient markets, the COMEX and the LBMA. They don't care. And you're seeing exchanges, the Shanghai Metals Exchange and their expansion in multi-jurisdictional expansion, one being built right now in Saudi Arabia, one just completed in Hong Kong, which allows you to take metal off of the exchange through Hong Kong and receive it directly by trading yuan into it. The people who are doing this are the central banks, and they are the most well-informed traders on the planet. That's number one. Now it's moving to the commercial banks who are telling their institutional size clients, early adoption is everything. And this is why most people fail at investing, because they move rather than trusting their intuition and listening to the rants of a guy like me. What the hell do I know? Or Alasdair, what do we all know? Well, we've been right. And we have been right. By hook or crook, we've been right.
Alasdair Macleod notes that global portfolios exceeding $300 trillion hold less than 0.5% in gold, and even a 1% increase would require around 25,000 tons metal that simply isn't available. Simultaneously, over 130 nations are developing central bank digital currencies, CBDCs, with 11 already launched, marking a financial shift toward digital control. Years of leasing have depleted central bank reserves, much of the gold likely absorbed by Asian markets. Andy Schectman warns that as institutions move from ETFs to physical metal, a sharp gold revaluation could follow. Nearly 40 countries have repatriated their reserves from Western vaults, signalling distrust in traditional custodians. The BIS confirms that 93% of central banks are researching CBDCs. Macleod adds that new exchanges in Shanghai, Hong Kong, and Saudi Arabia reflect a move toward yuan-based real asset trade.
There is going to come a time, I think, when you're going to sort of start thinking, right, we've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular, agricultural products perhaps, because I think these prices are going to rise. They're going to rise very, very substantially. That's going to be the new place to go. And good technical analysts are already seeing this beginning to develop in the wider commodity sphere. So I think that's your game plan. The timing obviously is up to the individual investment manager, and I wish him jolly good luck. So to summarize, I think the first thing is you've got ahead of us, we've got a credit bubble popping. But realize that when it happens, this sort of neo-Keynesian idea that the Fed can control interest rates and bring down interest rates and bring down bond yields. No, that's rubbish. That's not going to happen, because what will happen is that bond yields will start reflecting the risk in credit. What risk? But just add the three elements of this risk. If you go and buy a bond, you're losing possession of the money, if you like. It's going into the bond, so you can't use it for something else. So there's an element of interest payment to cover that. You've also got individual borrower risk. So that is another thing that you take into account. And increasingly now, there is another factor, and that is when I get my money back, let's say dollars, let's say in a year's time, what's it going to buy? What's it going to be worth? What's the purchasing power of that money which I've committed to a bond or whatever? What's that going to be worth? So you can see that these three elements are likely to rise quite considerably as credit risk begins to dominate our thinking. And under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts.
When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts of 2%, in fact, missed it by 50%, they call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me, but there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS. And we know that. We've talked at length. John Williams says inflation's 11%. Shadowstats.com, not 3. So nominal returns, to Alasdair's point, are an illusion when inflation certainly is higher than we think. But, even at 3%, and they're trying to push rates down below that. But even say you get a 5% return, right now you're losing in real terms by John Williams' measurement, a negative 6% real return. And in that environment where you, to Alasdair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable, and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alasdair's points, in the bond market, and that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore. And so as the chief investment officer of a large commercial bank who has never acquiesced to anything more than a pittance of gold in your portfolio, he says, sell half your bonds and buy 20% gold, 60-20-20. You got Michael Hartnett, the chief analyst at Bank of America, says, no, it shouldn't be that either. It should be 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You have Jeffrey Gundlach, the bond king. I think he's the head of bonds for BlackRock, says, 25% allocation to gold is not overweight. This is a guy that's made his living selling bonds, the antithesis of gold. And you have all of these institutional level advisors and chief investment officers saying, you need to own some gold right now. And in all three cases, it's at the expense of the bond portfolio. You didn't hear them say trim your 60% stock portfolio. So right now, I think there is no question that the world is beginning to understand that not only is the Fed trapped, raising rates blows things up like the bond market and all of the institutions that hold their wealth in treasuries, like the banks and the insurance companies, and the real estate market. And we're already looking at a Fed, they're projected here to lower rates into an environment where they're missing their target by 50%. That's acquiescence. We're going to give up, in essence, our mandate without really acknowledging it to inflation target of 2%. And by the way, it's funny, as a side note, just for those people who haven't heard, I asked Judy Shelton, I said, Judy, why the hell did they ever come up with this stupid 2% rate anyway? Shouldn't it just be zero, flat prices? Wouldn't that make standard of living better? She says, it was Janet Yellen's husband who came up with it, actually, and he said, if you do that, you can't give your employees raises because it'll come from the bottom line if everything is stable. But if you have a 2% inflation target and give your employees a 1% raise, they feel like they're getting ahead even though they're falling behind. And that's really what's happening here. We're all falling behind in the face of a dollar that is losing value precipitously. Last thing I will say is that when we look at the value of the dollar in terms of purchasing power, which is important because that's really what it is. Alasdair says you might get your money back, but what's it going to be worth? We're misled by measuring it against the Dixie, the other crap currencies that are all losing value. And the dollar was down 11% against these crap currencies. It's rallied back to 7 or 8%. Okay, but let's measure it against gold. It's down 50%. Against silver, 60%. How about last year? Same thing. When you measure, if you go back to 1971, James Rickards would say gold should be $94,000 right now, measured against gold. When you measure the dollar against a basket of worthless currencies, it's masked. So everything that we are doing is stacked against us in measuring against a basket of worthless currencies. Measured against gold, and everything is falling in price. And I think the asset managers must understand that even the best laid plans, those that have worked for 50 years wonderfully in an environment of dollar supremacy, in trust of the institutions of this country and of the bond market that has been weaponized and sanctioned, those things aren't the same anymore when that environment changes. So yeah, to Alasdair's point, you must pivot if you are looking at a macro perspective here. And when you see all of this congregation in the equity market on leverage and on margin and using options at record levels as the institutional sized traders and have been selling all year, and Buffett sitting on $500 billion in cash, what could possibly go wrong? The best laid plans need to be reevaluated, and this is the time to do so.
The global financial landscape is undergoing a significant transformation as traditional investment models face mounting pressure. The long-standing 6040 portfolio rule favouring bonds and equities is losing reliability amid persistent inflation, distorted asset valuations, and declining real returns. Central banks' inability to control inflation, coupled with eroding purchasing power, exposes the illusion of nominal gains. Investors are now being urged to pivot toward tangible and intrinsic assets such as gold, silver, base metals, and agricultural commodities, which are expected to outperform in an era of monetary instability and credit risk. As bond yields begin reflecting true credit and inflationary risks, reliance on conventional instruments becomes increasingly dangerous. Is it time, therefore, for investors to rethink portfolio structures that were built on decades of fiat-based growth and instead embrace real assets as the foundation of financial resilience in a changing economic order? If this insight opened your eyes, tap that like button and share your thoughts below. Your opinion matters here.